Yeah, we have heard of it
Or
like
just
many times. Probably many people that have heard of it. So what is it really about, right?
yeah, correct. What is it all about? Actually, in a layman term, it's actually very simple. It basically means you're buying a dollar bill for 60 cents. That's it. Like example, you see this one ringgit note. This
Yeah.
one ringgit note, you know, is worth one ringgit. Very
Yeah.
simple. But if someone were to offer it with you this one ringgit, or you can buy it some place or somewhere where in other countries where they don't appreciate this, then you can buy it at 60 cents. Oh, then you are making money already. When you buy it, you're already making money. You're already making 40 cents per month. It's as simple as that. Yeah. Buying a dollar bill for 60 cents. Yeah. But of course, when we apply value investing here, we are not applying towards currencies. We are applying towards stocks, businesses.
Okay.
Yeah, stocks. So in this case, what we are talking about is about stocks, how we value stocks, and we buy at the price which is giving us a margin of safety in that. So I want to share about the three core principles behind value investing. Now, when we talk about value investing, there are three principles that must be adhered to, or the kind of mindset a person needs to have. So the first is when they buy stocks, they have to understand that when they own stocks, they become an owner of a business. So in other words, example, if you buy, say, Old Town shares, when you buy Old Town shares, then you have to have the mindset that you are becoming a co-owner of Old Town in every single Old Town in Malaysia. So every time whenever people go to Old Town to buy food or to eat,
to drink coffee,
drink coffee, you are making money. Yes, you are making money from it. So because this is important, because many people when they buy stocks, they view themselves as owning a piece of paper. So they are not owning, they don't see themselves as an owner of the business. Yeah. So I find that's probably very important to have this kind of mindset. Then the next one is to have the temperament of yourself. You need to have the temperament to be patient and to believe in yourself and to trust and your analysis, and of course to understand that the market is there to serve you, not to guide you. What does it mean? It means that the market price, it fluctuates. So sometimes even the company's fundamentals is intact and there's nothing wrong with the company. But the share price, it just because depends on the mood of the market, the price might just come down. But in reality, there's nothing wrong with the company. So that kind of situation provides you an opportunity to buy.
Yeah, that makes sense.
So and lastly, margin of safety. Margin of safety basically means you're buying at something which you're buying something which is worth way more than what you
pay for.
Way more than what you paid for.
Okay.
Correct? Yeah. So that's the meaning of margin of safety.
So let me recap this.
So
you're saying that no value in investing, that these are the three core principles. So the first one is you have to think of owning the business. So it's some kind of like you have to treat you as the business owner yourself, right? Something like that.
Correct. Yes. Correct.
And then
you treat yourself as the co-owner of the business.
Co-owner of the business. And the second one, you say that the market is there to serve you, not to guide you. That means I really resonate with this, because some people they buy based on the trend. They buy based on the hot trend on the market. They well, when things getting better, getting good, they feel confident to buy stuff.
Yeah,
so it's like
correct.
Following the herd kind of mentality. So, and you are saying that the market is just there to serve you, not to guide you, which is very good. And the third one, you say margin of safety is we should buy something at a very large discount, and that means we're getting a bargain.
Yes, correct. And the very important thing is the downside, because number one, it protects your downside, and number two, it increases your return. Because the higher the margin of safety, the lower your risk is, and on top of that, the higher your return.
Okay, awesome.
So in this, when you apply value investing, it actually, the lower the risk, the higher the return, which is probably opposite what normally people preach. because normally people preach higher risk, higher return. You see, get higher return, then you take the higher risk. But in value investing, it's not so, right? Because of margin of safety principles.
Yeah, to me, it really sounds like a very safe way of investing.
Yeah, yes, very true. I think it's very safe way of investing too. Yeah, that is why when I invest value investing, currently I'm an investor. Currently, my wife and I we virtually have 90% of our money in here in
Mm.
stocks, and
Wow.
we do not find having 99% is considered risky for us because uh, we really know what we are doing, and of course we provide for our emergencies as well here.
Yeah, I understand. Also, you not just invest a lot of money, your own money in stocks, but also your family and your in-laws' families' money are also invested with you. And I also know that there are many investors that
Yeah,
are handing money over to you for you to manage and invest in stock using this value investing method. So maybe you can share with us what is your past performance, what have you done for them?
yeah. I think yeah. Oh yeah, this is my past performance. Yes. Yeah, this is my past performance for in the past how many years? 6 years plus. About 6 years. The past 6 years or so. I started keeping track of my performance in a,
Mm.
a early sorry in the month of March, where I really
Mm.
keep track. Started from
Mm.
March 2008, and I really keep track my performance. So from 2008 until 2013, over a period of 6 years, you can
Mm.
see my year by year return. You can see, and most
Wow.
years I outperform the KLCI. Most years, oh yeah, I think every year I perform KLCI, except for 2011 where my return actually underperformed KLCI. If you take KLCI plus dividend of probably about 3%.
Oh,
But
okay.
nevertheless, over the past 6 years, my compounded return is 25.6% annualized
Uh,
return, and when you compound over long term, it gives a total return of 270% currently. 270% means an additional an initial capital of 100K back then will have grown to about 370,000 today, nearly four
wow.
times. A little bit more will be about four times. Um, that really helps a lot in our retirement funding
Yeah. So
because
looking at your return here, uh, it's not hard to do. If we are, let's say, 5 years ago, if an investor just buy all the blue chips, all the KLCI counter, those are big blue chip, right? So they are going to get 7.3%, right? And but you
yes,
outperform
correct.
them. You
Uh,
outperform them. This kind of return, 25.6, is more like Warren Buffett's kind of return, right? But of course, Warren Buffett have a longer
uh,
track record, and
yeah, yeah. I think mine is very far away from Warren Buffett's record, because number one, Warren Buffett's have a very long history, probably about 50 years of record. So yeah, and now my record is only 6 years, so there's virtually nothing to compare with him. And the second thing is, I think it's not fair to compare with him, is because he's currently managing probably about 100 billion plus or 200 billion dollars of
yeah.
assets, where I'm managing like what, very small, probably about 20 million or so. So in that sense, what I'm
Mm.
managing is a small fraction of what he's managing. Uh, and so in that sense, um, probably instead of a person investing with Warren Buffett, probably the person can also learn out how Warren Buffett invests, and
Mm.
that it provides an advantage because of the size. It mainly comes from the size, actually.
Yeah, yeah.
Because of Warren Buffett's the size currently so big, it's very hard for him to find investment opportunity at that kind of capital. Uh,
So it's even more challenging for him to manage, right? He has so much money. So
yes,
if you
correct.
are trying to find bargains all the time, if you have so this kind large sum of money, how do you find such bargain every time,
Yeah,
right?
correct,
Wow.
correct. And his budgets now, he needs to look into billions.
Yeah.
Anything that is like 10 million or 5 million deal, it cannot make a difference for him. So he needs to buy in billions. So every day he needs to make in bills. Otherwise, it doesn't make a difference.
So true.
Whereas for me, if I can find a deal of 1M or 2M, I'm very happy already. You see. So that's a very different ballgame
Yeah.
altogether.
So in other words,
Alright, then let's
no, when we come back to the return rate we want to get from the retirement fund, just now the spreadsheet you show. So if a person want to get 7 point something percent, if you just invest in KLCI, buy only the blue chip or buy the index fund, you are easily can get like 7%, right?
yeah,
But
7%.
yeah,
Or
so
probably over long term, if you include dividends, probably about 8 or 9, some I guess.
so if they want
the
higher
thing is
return, then if they can do value investing themselves, they can definitely beat the KLCI index, right?
Yes, definitely. In fact, that's the purpose of investing for value investors. Because if we cannot get a return better than KLCI by itself, then we should not be picking stocks ourselves altogether. We should just buy an index fund and just forget about it all, everything. So that's why our benchmark is always KLCI plus dividends.
So what's your thought about some unit trust fund? No,
unit trust fund.
Yeah, I'll let you talk about it.
Generally, unit trust. I'm not sure whether if there are any unit trust funds that performs value investing philosophy. I've seen many where they say they perform value investing philosophy, but when it comes to application, I don't see the connection. And some of the stocks they buy also it's really questionable, because some of the blue chips, although they are considered blue chips, but their performance is just really mediocre businesses. And if you buy mediocre businesses at a good price, it's still okay. But when you buy mediocre businesses and they are still holding on even when the price is fair value or overvalued, then I think their aim is probably just to match the KLCI's performance. So I find that most unit trust funds in general, probably their aim is just to match KLCI's performance, or slightly outperform or slightly underperform. So in that sense, that's not the way I wanted to go to, unless I just want the KLCI's return.
Yeah, so in other words, I guess they are trying to play on the safe side. You know, they don't want to be too far away from the KLCI, right? They're trying to match it.
Correct.
Maybe you 20 or 30% of their fund just to do some better performance.
Hanky panky.
Just outbeat KLCI a little bit, then they are doing okay.
Yeah, correct. Very true. So in that sense, if they lose also, they don't lose much. Then if they win also, but the problem is if they can't with this kind of thinking, when they outperform also, they don't outperform much also. Frankly speaking, most of my ideas I gain not from the blue chips, because most blue chips are either fairly valued or overvalued. So that's not the place where I find bargains. That's why you can see my return is very far different from KLCI. Either I make a lot or I lose a lot. But so far, luckily, I don't lose a lot yet. So I think that's still good.
I still remember one of saying is when you say when you are getting like 52% on 2010, you're getting 25% last year, it doesn't really excite you, because during those good time there's not much action for you, because all your stocks is going to appreciate anyway. But the action lies when back in 2008, then that's all the action happened.
Yes, very true. That's the time when I need a lot of capital. But that's the time when back then when I started, my capital was very little. Luckily, one thing is that the bank lends me money. So in that sense, I'm pretty thankful to the bank for lending me money back then.
They are always helping
refinancing.
They are always helping people to get rich. Banks is our friend, right?
Yeah, correct. If you know how to use the capital, then I think that's very helpful also. So the bank really helps me a lot also. At that time. Okay, so let's go next one.
Good.
Yes. Now this is generally how I evaluate stocks. How I evaluate stocks. Before I talk about evaluating stocks, I categorize them into 9 boxes.